Today, there has been a wave of major developments across the cryptocurrency market, and XRP holders especially have a lot to pay attention to. Over the past 24 hours, the price movement itself has not been extremely dramatic, but the amount of news and important discussions emerging around crypto regulation, market conditions, and institutional participation has been very significant. All of these factors together are shaping the broader outlook for XRP and the entire digital asset industry, so it is important to break everything down carefully. Hey guys, welcome back to Whiteboard Crypto Update. In today's video, we will talk about XRP. So be sure to stay focused, as you surely don't want to miss out on this. If you're new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads. This video is for educational purposes only. It is not financial advice. Always do your own research before making any investment decisions. At the moment, XRP is trading around the $1.40 level. The price hasn't experienced any explosive movement recently, but it is still holding within a range that many investors are watching closely. Movements like this are relatively minor compared to the volatility we often see in crypto, but they still provide clues about overall market sentiment. Investors are also paying attention to macroeconomic events, including the release of initial jobless claims in the United States, scheduled for 8:30 a.m. Eastern Time. Economic data like this can influence financial markets broadly, including crypto, because it affects expectations around inflation, interest rates, and central bank policy. Looking at the broader crypto market, Ethereum is currently around $2,400, showing a small decline of roughly 0.5%. Solana is trading near $185. Overall, the market is relatively calm at the moment, without extreme movements in the major assets. However, outside of crypto, there are several developments that could influence market sentiment. One of the biggest factors currently drawing attention is the movement in oil prices. Oil has been extremely volatile recently. At one point, it surged to around $95 after previously dropping toward the $76 level. That means oil experienced roughly a 25% increase in a very short period of time, which is a massive move for the energy market. Much of this volatility is tied to geopolitical tensions. Reports have circulated about drone attacks connected to regional conflicts in the Persian Gulf, including incidents involving damage to oil tankers. Situations like this immediately affect oil supply concerns, which pushes prices higher. Rising oil prices can have a ripple effect throughout the global economy. When oil becomes more expensive, it increases transportation and production costs, which can drive inflation higher. Higher inflation then forces central banks, such as the Federal Reserve, to reconsider their policies, including interest rate decisions. These decisions directly impact stock markets, commodities, and even cryptocurrencies. That is why investors in crypto often keep a close eye on the energy market and global geopolitical developments. Some analysts have even speculated that certain geopolitical actors may attempt to push oil prices extremely high, potentially even toward levels like $200 per barrel, as part of broader economic strategies. Whether something like that could realistically happen remains uncertain, but the discussion itself shows how tense the global energy situation currently is. If oil were to surge dramatically, it could create significant fear across financial markets. At the same time, other traditional assets such as gold and silver have recently cooled down after earlier rallies. In the weeks leading up to geopolitical tensions, many investors rushed into precious metals as safe haven assets. Now that the situation has stabilized somewhat and the worst-case scenarios have not materialized, prices have moved sideways. As a result, oil has become one of the most active commodities right now. Interestingly, the volatility has even extended into the crypto ecosystem. Some trading platforms offer tokens or derivatives that track commodities like Brent oil. In certain cases, traders who were positioned incorrectly on these synthetic assets were liquidated when oil prices moved sharply. This highlights how interconnected global markets have become, with crypto platforms now offering exposure to traditional financial assets. Before going further, it is always important to emphasize that discussions like this are for educational and informational purposes only and should not be considered financial advice. Anyone considering investing should always perform their own research and due diligence. Now, shifting back to the crypto market itself, one of the most significant pieces of news involves regulatory cooperation in the United States. The U.S. Securities and Exchange Commission and the Commodity Futures Trading Commission have reportedly signed a memorandum of understanding to collaborate on crypto regulation and digital asset products. This development could be extremely important for the future of the industry. For many years, one of the biggest problems facing cryptocurrency has been regulatory confusion. The SEC often argued that many crypto tokens should be treated as securities, while the CFTC frequently classified them as commodities. Because these two agencies operate under different legal frameworks, the disagreement created uncertainty for companies and investors. With two regulators claiming authority over the same industry, businesses often didn't know which rules applied to them. This uncertainty discouraged many large institutional investors from entering the crypto market. Trillions of dollars in potential capital remained on the sidelines simply because major financial institutions prefer regulatory clarity before committing funds. Large investment firms generally avoid markets where legal interpretations are unclear, since potential regulatory actions could erase profits or create serious legal complications. The new Memorandum of Understanding aims to reduce these conflicts by establishing better cooperation between the two agencies. According to reports, the agreement includes regular meetings to discuss emerging regulatory challenges before they become major problems. It also allows both agencies to share data in real time regarding market activity, incidents, and potential risks. Another important aspect is cross-market surveillance and joint examinations. This means the agencies will coordinate their oversight efforts rather than operating independently. The framework also includes cross-training of staff so that each agency better understands the other's jurisdiction and regulatory responsibilities. In addition, enforcement actions will be coordinated to prevent situations where the same asset faces conflicting regulatory outcomes. Combined with ongoing legislative efforts in Congress, including proposals for a broader crypto market structure bill, this cooperation could remove a significant portion of regulatory uncertainty. If clear rules are finally established, many analysts believe that institutional money could begin flowing into the crypto market at a much larger scale. For years, financial advisors avoided recommending crypto investments to their clients, even during periods when the market produced massive returns. Part of the reason was regulatory risk, but another factor was the stigma surrounding cryptocurrency. Many politicians and regulators criticized the industry heavily, often suggesting that digital assets were mainly used for illegal activities. That negative perception discouraged mainstream financial institutions from embracing the technology. However, if governments begin providing clear legal frameworks, the situation could change dramatically. Large financial institutions typically prefer operating within well-defined regulatory systems. Once clear guidelines exist, they may feel more comfortable offering crypto investment products to their clients. There are already early signs of institutional participation, especially through exchange-traded funds. For example, XRP-related ETFs have reportedly accumulated around $1.4 billion since launch, even during periods when the asset's price has pulled back. That suggests that some investors continue accumulating XRP at lower price levels rather than abandoning the asset. Although the price performance may not have met everyone's expectations recently, the fact that institutional products continue holding significant amounts of XRP indicates ongoing interest. Investors appear to be positioning themselves for potential long-term developments rather than focusing only on short-term volatility. Another interesting perspective comes from comparisons between Bitcoin and gold. Some analysts have pointed out that Bitcoin's valuation relative to gold is currently similar to the ratio seen in late 2017. That period is particularly notable because it occurred shortly before a major crypto market correction in 2018, when Bitcoin fell from around $20,000 to roughly $3,000. This raises an important question. Does the current ratio suggest that crypto assets are overvalued, or does it mean they are undervalued compared to gold? There are different ways to interpret the data. Gold has increased significantly since 2017, rising from roughly $1,346 per ounce to around $5,000 in some recent estimates, depending on the metric used. That represents roughly a five-fold increase. Bitcoin, on the other hand, has also grown substantially over that time period, but at a somewhat different pace, depending on the measurement point. Some analysts interpret the current ratio as evidence that crypto could still have room to grow relative to gold, while others worry it might signal potential downside risk, similar to the 2018 correction. Another metric often discussed is the relationship between crypto markets and global money supply, commonly referred to as M2. In previous cycles, Bitcoin's price movements appeared to track changes in global liquidity relatively closely. Recently, however, there has been a noticeable divergence between the growth of money supply and crypto market valuations. This creates another important question for investors. Will crypto eventually catch up with the expanding money supply, or will the divergence continue? Some analysts believe the market may eventually align again with broader liquidity trends, but the timing remains uncertain. Many observers think the answer could depend heavily on upcoming legislation such as the proposed Clarity Act in the United States. If that law is passed, it could provide the legal framework that institutional investors have been waiting for. Large pools of capital might then begin entering the market more aggressively. Until that happens, the crypto market may continue to move cautiously, with investors waiting to see whether regulatory clarity finally arrives. Short-term rallies are always possible, but the truly massive bull runs many people anticipate may require stronger regulatory certainty. So right now, the big question remains, will the crypto market recover strongly before new regulations are finalized, or will investors continue waiting on the sidelines? Some people are using this period to accumulate assets gradually through strategies like dollar-cost averaging. Others are reducing exposure or diversifying into different investments. Whatever strategy investors choose, it is clear that the crypto market is currently at a very interesting point. Between geopolitical tensions affecting global markets, regulatory developments shaping the industry's future, and ongoing institutional interest in assets like XRP, the next phase of the market could be extremely important. Well, guys, that's all we have for you today. What are your thoughts on XRP? Get involved and let us know in the comments down below. If you guys like this video, then be sure to give this video a big thumbs up. Thank you for watching, and we will see you again in the next video. Goodbye.